All right. Hello, everyone. Welcome to class number 18. Uh, today class, we're going to wrap it up the ethics, which means we're also wrapping up the 18 hours national, course material. And the next two classes are probably going to focus on the California DFPI, laws and regulation, within the California mortgage lending. Okay. So let me see here. We got it recorded. Okay. So it's been 18 great days, don't you think? Just like that. So after this week, I'm gonna hold another week of let's see if I can hold it within 4 days, and then we complete with everything. If not, then probably gonna 5 days. But mainly for the next week, I'm gonna just go over a practice test. Okay, and we go over the material of the practice test and strategy on how you're gonna, focus on studying as well as get ready for the test. Okay. Okay, class number 18. So same old thing, this whole landscape here. Eventually, that you're gonna get involved. You're gonna be a portion of this landscape. Imagine a seller and a buyer buying a home, and so many people get involved just just to help out with the transaction for the purchase transaction as well as the title transfer, just for these two great families, right? One want to sell, one want to buy, and then life just move on. All right. Okay, so to wrap up the ethics, um, we're gonna focusing on financial responsibility, some ethical behavior related to loan origination activities. Um, when we're talking about financial responsibility, right? Make sure whatever we do need to stay within the limit of the law. Okay, the permitted fees, the compensation, right? If it's permitted to collect fee, then do so. Right? Don't go outside of that. Don't do kickback, right? Don't do anything illegally, right? Always think the consumer. I put the consumer priority on top of the list. Okay. Um, Fee charges, closing cost scenario, referral fees, fee splitting, right? We're gonna cover all that today. So the Bureau is not prohibiting payment to and receive of payment by loan originators when a consumer pay upfront points or fee in a mortgage transaction. So meaning that in the mortgage transaction, sometimes the broker, um, even the loan officer can collect some upfront fees, right, to cover for their costs. Because imagine that what happened if you serve 1,000 uh, borrowers, and each one of them come to you and asking, well, can you help me with a pre-qualification, pre-approval, and then you end up like running a credit check, and then you pay that upfront fee, right? 1,000 of them, nowadays like $70. That is like a lot of money. Okay, 70 grand can be easily, right? So that's why those fee that you have to charge up front, so that you don't have to put your out of pocket money, right? Because eventually that they may be just shop around, right? Not until you close the transaction, that is when you collect your compensation and paying for all these kind of fees. So people time and effort cost, right? The loan processor process the application does involve some effort and time, right? Underwriter, right? The account executive. The funny thing is that the law allows the borrower to get involved in the mortgage transaction, but eventually the borrower can back out and doesn't have to pay anything, right? There should be some guideline that say, hey, if you change your mind, at least you gotta pay some fee here, because everybody time and effort just helping you out. Imagine like if somebody charged like $20 an hour, $30 an hour, and they spend like 5-10 hours to helping you, and then you probably decided, okay, I don't like this home no more, I want to back out, and then everybody time and effort just like go down the drain, right? It's not fair. right? But anyway, the laws allow that, so nothing you can say about it. Okay, so that's why sometimes they charge an upfront fee, application fee, credit, check fee and all that, right? So at least to recoup some of the money for the effort that's spent. Okay. The lender will pay all the loan origination fees for the service, which is predetermined between the lender and the broker and cannot be changed. So this is like an agreement between the broker and the lender. Say, hey, Mr. Lender, I want to work with you, but this is my fee, 1.56, 1.7, 2.0. That's how I'm going to collect from you if I close this loan. Okay, the lender say, okay, that's fine. If you bring me as much loan, as much transaction, then I'll give you 2.0. Okay, how about we start out with a 1.5 first, right? I'll pay you 1.5 point, right? 150 basis point. Okay, then we have a deal, right? Those are the fee that be set by the broker and the lender. Okay, so when the loan officer pick a broker or the lender pay, right? That is already set, right? Whatever the broker charged the lender, right? That's going to reflect on the loan estimate. That's going to reflect on the closing disclosure or CD, right? But there's also option that the buyer can just go with buyer pay, right? Or I should say that loan officer can pick the buyer pay instead of giving like a 2.0 point or fee. The loan officer can lower it down to 1.5, 1, or sometimes even a 5.5, right? So the loan officer have more control and sacrifice that loan officer wants to charge on the fee. Okay, but you remember that one of the law, right? I believe it's a Dodd-Frank, right? It say that the loan officer cannot cut his or her commission to pay for the closing costs. Think about that. That is the law. The law says the loan officer cannot reduce the commission and use that money to pay for the closing costs. The law does say that, right? However, the way that process works is that instead of say that I give the borrower half of my point and then using that to pay for closing costs, right? That is so obviously, and that is actually against the law. However, the loan officer can do is that voluntarily reduce the commission to a 0.5 from a 1, or reduce from 2 to 1 without having to say anything. And that reduction show in the loan estimate, that reduction show in the closing disclosure. But it doesn't say that that money of reduction will help the borrower to pay for closing costs. But guess what? That's what it is, right? When the loan officer reduce the origination cost, it's actually helping the buyer or the borrower to pay for the cost, right? Or pay less. Let's put it that way. Pay less for for the total closing cost, including the origination fee. So one way or another, right? The law say this, but there are other way that people can do, right? Obviously, I'm not doing anything illegal. I just reduce my origination fee. That's all, right? So things like that does happen, nowadays. So, but at least just don't say, hey, I reduce my commission or my loan origination fee so that you can use that money to pay for the closing costs. Don't say that. Okay, if you want to do, just do it. Okay, don't say it. Okay, because that's against the law. Okay, allow the mortgage broker to pay for their employees or contractor commission, although the commission cannot be based on the term of the loan that they originate. What does a C mean? C say that the broker can pay commission based on the performance, based on the volume, based on the business that bring in for the broker. The broker can give some bonus, right? Something in return. But that bonus that money, give it to the loan officer, is not because this loan officer for this particular loan able to get the borrower go for a higher rate, bad term, and all that. Because you do that, I'll give you the commission. No, right? Because you do that, I give you the bonus. No, right? That is a no. But if the borrower able to close as many, 5-10 loans a month, right? Close like 5 million or 10 million a month, then here, this is your bonus. Okay, it cannot be determined because of the loan that person that get the bonus or commission. Okay, prohibit a creditor or any person from paying directly or indirectly compensation to a mortgage broker or any loan originator that is based on a mortgage transaction term or condition, except for the amount of credit extended. So meaning that any lender cannot pay to the broker or the loan officer because they sell this loan product, higher term, higher fee, right? I should say worse term, higher fee to this borrower. And so that's why you get this money, right? Whether that money is a credit or a commission or whatever, okay? Sometimes the lender give credit, right? Give credit to the broker, give credit to the loan officer, okay? The loan officer, the broker can disclose that to the borrower too, and can give that credit to the borrower if the loan officer or the broker want to do so. If not, the loan officer can just keep that credit. Sometimes the credit, if you get the loan product that 7%, you got $5,000 or $10,000 credit. If the loan officer doesn't give it to the borrower for a 7% rate, then the loan officer keep $10,000 plus the commission. Okay, so that's why sometimes if you see that loan officer like try the borrower to to like a bad loan instead of finding a good loan, right? The loan officer give the introduce a bad loan to the borrower and keep the credit, right? So that's what it means. Okay, the final rule generally prohibit loan originator compensation based upon the profitability of a transaction or a pool of transactions. Okay, so meaning that if the rule say you cannot get compensated by make profit on a transaction or many transactions. Okay, the broker cannot pay you that. Okay, your performance may give you some some bonus, but just because like you are keep selling bad loans, right? And then eventually the broker make more money, and then you get some some money, and that's prohibited. Okay, no loan originator may receive compensation from another person in connection with the same transaction. Okay, so on the same transaction, right? You cannot get the you cannot get the dual payment, meaning you cannot get the compensation or commission from the lender and from the borrower. You cannot do that. You can only get one or the other. Or any fee, right? Escrow probably going to give you some fee. Lender may give you some fee. Title may give you some fee. It's not allowed, okay, for that particular transaction. And last time, I think Jung was asking about, hey, can I refer somebody to another loan officer and collecting referral fee? No, you cannot. Okay, only realtor can do that. Nobody else can. Okay, prohibition against dual compensation. So I just mentioned about that. Okay. Ethically, how do you handling borrower complaints? Okay, complaints about the banks and lender to report problem with the bank, financial institution, lender, or broker. Okay, if you have any issue, you need to report that either to the to the bank manager, or you can even report it to the commissioner or to the NMLS. Well, there may be a division for file a complaint. Okay, you can contact the branch manager, the customer service hotline, or the institution website. Provide a letter to explain your problem and how you want the bank to fix it. Provide copies of receipt, checks, or other proof of the transaction. If contacting your bank directly does not help, you can complain with the CFPB, which is Consumer Financial Protection Bureau. Okay, that's your line, right? If you're not satisfied with any particular transaction and you think there's something fishy, you can definitely go to CFPB. Report a mortgage company for discrimination, go to CFPB, because CFPB enforce Equal Credit Opportunity Act, ECOA, right? ECOA is a Equal Credit Protection, Equal Credit Opportunity Act. So that means everybody should have an equal opportunity to borrow a loan. Whether that person get qualified or not, it's another story. Okay. ECOA prohibit lender from denying credit because of certain characteristics. You remember there are 7 characteristics, right? Sex, gender, age, origin of national, and there are a few more. Okay, I don't remember the whole list. Okay, you can file a complaint with the CFPB if a lender has denied a mortgage application because of discrimination. Okay, if you believe the lender discriminate you, I have the same financial situation like that gentleman over there, right? I'm a person of color, but he get the loan, but I don't. And if you feel that you are a victim of discrimination, then you just have to complain it with CFPB because they enforce ECOA. Okay, file a complaint about mortgage company services. Mortgage company services are the servicer who serviced the loan. Okay, we learned about this. The Department of Housing and Urban Development, HUD, enforces the Fair Housing Act. The Fair Housing Act prohibits discrimination when you rent, you buy, or secure a financial for a home. Your state may have like a similar law. File a complaint with HUD and the Fair Housing Office in your state if mortgage company discriminate against you because of discrimination. Okay, so you have HUD if you feel like you are a victim of the discrimination in the transaction or buying a property. Report deceptive mortgage practices and scams to FTC. Okay, FTC is the agency that handle all the deceptive, abusive practice or even scam, right, on the mortgage, or even on the actually FTC is handled for mortgage only. Okay, so it states that unfair and deceptive practices affecting the commerce are unlawful. Report a mortgage company to the FTC if it makes deceptive statements, omits important facts, or takes misleading actions. Example includes false statement about the ability to offer a loan, okay, fees or services that mortgage company didn't provide, illegal tactic to collect a mortgage balances. Okay, so any of these issues you can report to FTC. Okay, mortgage company compliance. What is mortgage compliance? Mortgage compliance is the industry's general term that refers to the rules and regulation that control the mortgage process. Why does mortgage compliance exist? It exists because it stays on the up and up with regulation. The first reason that mortgage compliance exists is the most obvious. In order to keep mortgage professional following the regulatory laws, keep everybody in line, right? Don't do a bad thing. So there gotta be somebody that enforce that, right? Regulation to protect consumer, regulation to keep to prevent the professional from committing crime or doing illegal things. Secondly, solve problem involving unconventional borrowers, right? So in order to get a compliance, right, then everybody have to do the right thing, and that actually solve many problems, either conventional or non-conventional borrower. Okay, another reason that compliance exists is for LOs, loan officers, as they help the conventional borrowers. Part of the loan officer's job is to act as a problem solver for their borrowers. Mortgage compliance helps guide loan officers in the do's and don'ts of mortgages. So pretty much compliance is a shield Compliance is it's a guidance that keep everybody in line. Number 3, act as a safety net against suspicious behavior. So compliance is pretty much try to teach everybody to do the right way, to learn the consequences, right? And then the bottom line is to help the consumer from predatory lending or abusive or discrimination. Okay, what are the major phases of mortgage compliance? TLR response integrated TRID. TRID is a compliance. You need to follow the TRID rule. TRID is one of the most recent regulatory changes added to the mortgage landscape. The TRID streamlines some loan disclosures and changes the timing involved in specific mortgage process. Okay, what is the timing involved? Right, 3 days after the application open, you have to send out the loan estimate. 3 days before the close of escrow, you have to send out the closing disclosure. So those are the timeline. Okay, Homeownership Protection Equity Act, HOEPA. Okay, HOEPA is helping home buyer and protect from overpaying PMI. Okay, private mortgage insurance, because there's maybe some servicer, even the keep collecting money, even the the borrower is already past 20%, past 22%, but they're still collecting it. So HOEPA tries to prevent that from happening. But if the private mortgage insurance, past the 20 mark, the borrower can call in and cancel that PMI, or 22% automatically cancel that PMI. Okay, if any money left, then credit need to be paid back by the servicer. Okay, so PMI through the Home Ownership Protection Equity Act, borrowers who have a down payment, okay, I already explained this, 20%, or loan to value 80% or 78%, right? And there's no PMI. Home Mortgage Disclosure Act, HMDA. Credit unions are required to collect, maintain, and report loan level details under HDMA. Additionally, HDMA is in place in order to track whether or not lending institutions are serving their community's needs. So HDMA require disclosures, right? And they make sure that lender follow the guideline and not discriminate, not redlining, not pick and choose the communities to serve or not to serve. Okay, mortgage company compliance, including flood zone determination. Flood zone determination requires financial institutions to no longer make a review any loan for a property that is located in a special flood hazard area. Okay. Why should an LO care about compliance? Compliance exists in order to protect consumer. Everything is about consumer. And minimizing a borrower risk, after all, should be a LO top priority. Okay. Sometimes it's just actually some pressure for LO sometimes that it's hard to get a client. And then when you get a client, right, if you reduce the origination fee too low, then you pretty much not making any money, right? You spend hours and hours, even months and years to help one client, right? So you just have to do the right way. Sometimes, right, you give the client the option, right? And I think it's better if you follow the broker guideline and try not to, unless you be professional enough, you get a clientele, client that come back to you. You have regular business, and that's okay. You can do borrower pay. You reduce some of the origination costs and all that. But try to stick with the broker, because the broker knows what they do, right? They set a guideline so that the business of the broker can stay in business, and people work for that business still make income, right? LO work for that business can still make with commission compensation, right? So just use that as a guideline and try not to modify that and then go on your own way, right? Because if you do that, eventually you're not going to make anything, right? And you're just wasting time. Compliance protect the lender as well, not only for consumer, but also for the lender. There are federal and state level mortgage compliance rules to minimize financial institution risk, right? If the lender keep, if the, let's say if the LO not do the good job, if the underwriter not do the good job for screening these borrowers, and eventually if thousands and thousands of borrowers got the financial situation, get bankruptcy, foreclosure and all that, and the bottom line is going to hit the lender. So that's why that's why the compliance in place also help the lender, so that they can stay in business. Compliance regulations are in place to track and improve the loan process, make the process smoothly, right? Make everything tight together, right? The way to make the mortgage process better is by tracking what we are doing. What are mortgage compliance best practices? Okay, what are the best practices, to be compliant, right? The first thing to remember is that maintaining compliance should be a consistent process. You don't do one time and you don't not doing the other time. Every time you do, it's the same. It's not an emergency measure taken when you realize it's clearly too late. Sticking to regulation practices throughout the entire loan process means less costly mistake overall. Okay, sometimes a broker may have a compliance department, right? Make sure the compliance department review the loan and make sure this loan doesn't make any mistake. Otherwise, it's going to cause audit and all that, and the cost is high. Living by standard of transparency is a large part of the remaining compliance. Make sure everybody knows everything, right? The borrower knows what they get themselves involved into. Okay, offering honest and upfront information will keep both the clients and regulators happy. Okay, relationship with consumer. Handling personal information, cybersecurity with care and protect, right? These information are really crucial and important, right? Gotta protect it with care. Disclosing conflict of interest to avoid kickback and unfair practices, okay? If you're working with any affiliated partner or company, right, you need to disclose that. So just try to say, hey, we have nothing to hide here. Requesting credit reports to ensure the borrower meets the ATR rule, ability to repay rule, right? You cannot just giving an approval without have to look at the credit history. But I know a lot of loan officers actually give out that approval without running a credit report. So you as a new MLO, try not to get that the same thing. You can give like a loan estimate. You can give a quote. You can give like a pre-qualification, but just don't give the loan approval or pre-approval until you run the credit check. Okay, changes in the down payment or offer interest rate need to be disclosure, right? Anything that change on the CD, right, affecting the rate, affecting the APR, affecting the term, then the new CD need to be disclosed. Okay, power of attorney is to act on someone's behalf by signing document. Power attorney is that if I cannot do something because I'm away, but I'm trust somebody, I get that person the power of attorney to help me facilitate my transaction, for example. Non-resident co-borrowers, they are financially responsible for paying back the loan if the primary borrower is not able to do so. So let's say if you have a co-signer, okay, a non-resident, meaning that co-signer is not live on the same property, right? Yep, and both of them, on the loan, then if the one that are on the loan live at the resident not paying, the other person is also obligated to pay back. Otherwise, it's going to facing foreclosure and affect the the credit score and credit history. Okay. Unreported or fluctuating income, okay, will affect the ATR. So income need to be calculated correctly and collected, and then put in the calculation and make sure this person have enough income to cover for all the liabilities and make sure the DTI is within the range of the allowable, loan program. Gift, unexplained deposit, need to clear disclosure to the source of the gift and deposit to avoid money laundering. Okay, if you have 15,000, 16,000, 10,000, 5,000 deposit, you need to know where that money coming from. I actually just did one today. Okay, I'm purchasing a property, and there's quite a few items in my bank statement, large number, that the lender required me to disclose. Okay, what are these? Where's the source? I say, oh, those are my commission, right? So I just need to explain every single big amount. Appraiser interaction. Try not to influence or interfering the appraiser. Let the appraiser, does his or her job, right? Don't get interfere. Don't get close. Don't ask questions. Just let him, or her do the job, and then you get the report afterward. That's including the LO and the borrower. Okay, try not to interfere the appraiser. Truth in marketing and advertising to stop the scam, right? And the ad must be truthful. So because there's there's a lot of scam. The goal is to prevent fraudsters from perpetrating scam in the future, freeze their asset, and get compensation for victims. Okay, ad must be truthful. The ad must not be misleading, and when appropriate, backed by specific evidence. So the marketing material need to be stored for 2 years to prove that your ad is actually legit. Okay, the FTC enforces the truth in advertising laws in newspaper, magazine, online, mail, or billboard, or buses. Okay, permissible statement in advertising. Regulation Z prohibits misleading terms in open-end credit advertisement. Anybody remember what open-end mean? Open-end credit mean? Okay, you have a HELOC. You got 100,000 equity in that HELOC, but you haven't used it, or you use it but you haven't locked it in a fixed rate. So it's called open-ended credit. Okay, and any advertising regarding to HELOC, need to be truthful and clear. Advertisers are responsible for ensuring that all express and implied complaints that an ad convey to reasonable consumers are truthful and substantiated. Okay, all information need to be true. Official advertising statement must be clearly legible. You cannot have like a term like at the really small fine print, and your discount is in the big print. Okay, everything needs to be legible to be able to read. Okay, some general business ethics. Falsify information by borrower or MLO. Okay, these are some ethics right here. Right, all information must be accurate and correct. Okay, given solicited and unsolicited advice, you cannot, if you don't have a license, okay, any license, you don't give advice. If you're not a lawyer, don't give law advice. If you're not a real estate, not a realtor, don't give don't consult and give the advice on the real estate. Okay, if you're not an MLO, you don't have a license of an MLO, then don't give an advice on lending, mortgage origination, right? You give advice on the license that you have. Okay, if you want to give advice, then you have to disclaim that. Say, I am not I'm not a tax professional. So what I'm sharing right now is based on my opinion and based on my personal experience that I share with you. Okay, don't take this as an advice as professional, or hey, I'm sharing some information here, but don't think that I'm a lawyer. Okay, this is not a lawyer advice. Okay, I just have to disclaim it. Okay, so like I say, only licensed MLO can give advice to lending and mortgage related products. Outside parties seeking information. Okay, somebody outside wanting some information must comply with the client data protection and don't share any information unless First, request for permission, sign agreement from the client. All right, client has the client has have to have the consent for you, or your broker, or the lender, whoever want to share that information. Okay, if you don't have that consent, if you don't have that authorization, don't share, because you're gonna get yourself in deep trouble. Okay, all right. Before I move forward, I have a couple of practice questions here for you. Okay, and some of you came in late. Let me drop this file again. Okay, take that. And now let's work together on these 10 questions, okay, as a practice test. Okay, like I say, the rule of thumb when you take a test is that you have to read the question carefully and understand the question, and watch out for negative words or negation words. Okay, or let's say number one, included in the loan estimate. What is a loan estimate? Right, by now you should know what a loan estimate is. Okay, and they say included in the loan estimate, all of the following are part of the finance charge, except, okay, I highlight the except, meaning that, okay, all of this are correct except one is not correct. Okay, so when you're seeing this, right, you don't quickly just read the answer number A and then pick it. Oh, this is probably it. Maybe there's some other one that down below, right, maybe the correct answer. So have to read the question carefully, right? So this question say all of the following, right? When you hear all of the following, you mean at least all of the, majority of the following answers, satisfy the question, except the one is not. Okay. So on the loan estimate, all of the following are part of the finance charge. Okay, except which one? Which one is not a finance charge? Which one may be not outside of finance charge, or which one may be the finance charge majority is actually the charging, allow in the mortgage or any payments. Okay, so let's take a look at this one. Appraisal cost, is it a finance charge? Okay, can you shop for the appraiser? You cannot, right? The appraiser is picked by the lender, right? VA funding fee. Remember, one of the top fee for the VA loan is a funding fee. You don't have the PMI, but you have the funding fee. So this is a charge from the VA, taking the VA loan. Okay, can you shop? No, it's preset. Per diem interest. What is a per diem interest? Per diem interest is that if you take the property, the interest of the loan, right, by divided 365 days to get a per day interest charge, and then how many days that left over of the month before you take on this loan, you multiply that number with the per day interest rate, or interest that you pay, not rate, interest that you pay, and that is a per diem interest, like the total amount that you have to pay, right, using the per day, per day interest, right, or usually they call it per diem. Okay, origination charges. Okay, you take on the loan, you have to pay for the origination fee. Okay, so which of these are, now which of this is the except, or the one that is not finance charge? If you know the answer, type in the chat box for me. Come on, give me a try. Don't be shy. So A, B, C, or D. Okay, so there are at least 3 of the answers are correct. 1 is not. Okay, so why don't you type in the what do you type in your answer here? Nobody want to give it a try? Appraisal. So somebody say appraisal is not the finance charge. Okay, but you remember that? Can you shop for the appraisal? You pay for it, but can you shop for it? You cannot shop for it. So it's part of the charge. Okay. VA funding fee, can you shop for it? No, you cannot shop for it. Origination charge, majority of the time, right? It's got a charge. Okay, why don't you record that answer? And then we're gonna come back with this, okay? And now let's move on. Okay, number 2. A buyer has made an earnest money payment of 5,000. Earnest money payment, or the earnest money deposit, or EMD of 5,000. Okay, so you make an offer, right? You put in the deposit of 5,000, to the seller. Keep it in the escrow. The buyer pays an additional $2,000 in option money to be credited at closing on a property with a sale of $160,000. If the required down payment is 20%, how much additional money will the buyer need to provide toward the down payment at closing? So this question is kind of asked, okay, if you buy a home at 160,000, okay, and you plan to put in 20% down payment, okay, but initially you already give in $5,000, and then you pay an additional $2,000. So how much do you still need to put in for fund to close at the end of the escrow? Okay, can anybody guess? 25,000, 27,000, 30,000, or 32,000? So how do you even calculate this, right? A quick and easy way to calculate this is that, what is the sale price? 160,000. What is the required down payment, or what is intended down payment? 20%. So 20% of 160 is what? 32,000. 16 times 2, right? 32,000. So 32,000, and then you put in 5,000, and you put in 2,000. So how much that you need to bring it on the table to close this transaction? Okay, A, B, C, or D, right? You do the calculation, and then you keep track of that, and the answer will come. Okay, number 3. If an applicant works 40 hours a week and is paid $13.52 per hour, what is the application monthly income? You remember this, right? We talk when we do the applicant gross monthly income, right? If it's a biweekly, right, you have to multiply by 26 and then divide by 12. Why do you multiply by 26? Because you get 26 paycheck, right? So that you calculate the full year. And then to find a monthly, you take the full year salary, and then you divide by 12 to get a monthly. Okay. And then, if you work monthly, then you're using a monthly. If you work hourly, right, per week, then you calculate that. So 40 hours per week. So now we're talking about per week, right? And each hour that you work, you get paid $13.52, right? So now you have to calculate how much you make a week by multiplying that 40, with the 13.52. But now that 40, but that is only a 1 week, right? So how many weeks in a month? Or should I say, how many weeks in a year? Because if you multiply only by 4, and that is your final answer, then you're wrong, right? Because you only take into account of 4 weeks, but sometimes there's a month that have 5 weeks in it. So you need to multiply that week by 52, and then you divide by 12. Okay, so I see that Quang has a similar answer. So you pick the answer for this. Okay, A, B, C, D. Use a calculator. this is something that the math that you're gonna have to do on the test, and they give you like a little, erasable, like a mat with like a laminate that you can write it on, and then they can just wipe it off. Okay, and they also give you a calculator, right? So Quang here give the equation, right? If you punch in the equation and then you get the answer. Okay, so the answer for these three questions are, first, the appraisal cost. Okay, because VA funding fee is the fee that you have to pay. It's a financial fee that required. Per diem interest is calculated based on the interest that that based on the rate, based on the term, right? And that's how much you're going to pay per per day, and then the remaining of the month, right? So that is based on the financial information. Origination charge is that you charge 1% of the full amount of loan, right? That's the financial. Only appraisal cost is the static, okay? And that is something that you pay to an outsider, right? For the service that they provide, even though that you cannot pick them, okay? So number two, the correct answer is $25,000, right? So you take 160 sale price, you multiply by 20% down payment, that equals 32,000. 32,000, you put in 5,000, and then you put in additional 2,000, that total of 7,000, right? 32,000, subtract 7,000, you get 25,000. So the correct answer is A, okay? So you have to read this carefully, right? When they say buyer paid an additional 2,000 in option money, we got, option money is just an option that you can put in the money, right? So you have to read it carefully. You don't just only take into account 5,000 and your answer going to be 27,000, okay? Then B is wrong, right? So an addition 2,000, so you add it up to make it 7,000. Subtract by 32,000, the answer is 25,000. And number three, okay, you punch in this equation, okay, then you got, you calculate a weekly income, and then that weekly income you multiply by 52 weeks per year, okay, not multiply by 4 and then use that monthly income. No, that's not correct. You have to multiply by 52 and then divide it by 12 to get the monthly income. If you get a pay by bi-weekly, then you multiply by 26 and then divide by 12. Okay, keep that in mind. Okay, next one, number 4. The requirement for a private mortgage insurance, PMI, is generally discontinue, meaning that you stop paying when the loan to value LTV falls below which percentage, which loan to value that you don't have to pay, the PMI. Is it 20%? Is it 50%? Is it 80%? Or is it 90%? Okay, we know if the if the equity fall into 20% or higher than 20%, then you don't have to pay the PMI. So when the equity is 20 or higher percent, that meaning the loan to value is dropping to 80% or lower, right? So this question is for that. Okay, so keep track of which number it is. Okay, number 5, the unique identifier of any person originating residential loan must be clearly shown on all of the following document except. What does that mean? That meaning that a unique identifier, what is a unique identifier? Unique identifier is a unique number. It's like a social security number. But in this case, it is an NMLS number, which is the first number I told you to register for. Hopefully that everybody have an NMLS ID number by now, right? So the unique identifier of a person originating residential loan. What does that mean? An NMLS of an LO. That first half of the sentence is that mean. Okay? And this NMLS ID must be clearly shown on all of the following documents except. Remember that? Except. Right? You have to read that. Except right there. Okay? And they say all of the following, but except one thing. Okay? The NMLS ID need to be appear on business card, company website, residential mortgage loan application 1003, Consumer Financial Bureau special information booklet. Okay, which one is that? Okay, there are 3 correct answers that NMLS ID need to be on it, and there one that is not on it. Okay, so you think about that. It should be easy. Okay, number 6. According to the Truth in Lending Act, Chilla, the term refinance apply to. What does a refinance mean? First, you buy a home, you finance for the home, right? And now once you get the home, you want to lower your term, you want to lower your payment, or both, or you want to cash out, then you refinance, right? To get the new loan, new term, new payment. That's what it's called, refinance. So the term refinance apply to which one of this? Okay, here I don't see anything say or, I don't see anything say except, right? And this don't see the term refinance apply to. And I don't see in the ABCD here say D is all of the above, right? So the answer should be only one answer, okay, out of the 4, A, B, C, or D. Okay, refinance apply to reduction in APR. Is that true? Okay, is refinance applied to a change in a payment schedule? Payment schedule, only change in payment schedule, or is anything changed when you refinance? Keep that in mind. The renewal of a single payment obligation with no change in the original terms. What does that mean? Okay, so meaning that it's renewal of a single payment obligation and it doesn't change the term. Okay, meaning that you make a one-time payment, but everything stay the same. More or less you put in like money to pay the principal. Is refinance is that. D, the satisfaction of an existing obligation and its replacement by a new obligation. Oh my God, this thing is so confusing. Is that confusing? What is obligation? What is satisfaction? What is replacement? What is existing obligation? What is new obligation? So this question is going to be confused by a lot of people that taking a test with limited English understanding. So that's why you need to clearly understand the question and clearly understand the answer. Okay, so number D is saying the satisfaction of an existing obligation and its replacement by a new obligation. Okay, anybody pick A? Anybody pick B? Anybody pick C or D? Okay, the answer comes. Okay, I'll go back to number 4, right? When the PMI is falling, the loan to value falling below 80%, that means when the PMI can be stopped. But is it stopped right away? Or you have to make something? You have to call into the servicer, say, hey, Mr. Servicer, I'm reaching my 80%, stop it for me. Okay, hey, what happened if in the number 4, the answer may include 50, 80, 82, and 90? Would you pick 82 or would you pick 80? Right, so you have to, in that case, both of them are actually correct. 80 or 82 is correct, right? But you have to read the question carefully, right? And say, okay, the question may involve in say, may include it automatic. Okay, the phrase of the question may include an automatic discontinue, a stop, right? And which one is that? If 80 and 82, I would pick 82, right? Because with 80, if you don't remember, if you pay and you don't know that you already pay more than 80, your loan to value is already choppy for 80, then you have to call in. But the automatic meaning that you don't even have to call in, the servicer will stop that for you. Okay. So number 5, right? Unique identifier need to be the NMLS ID need to be on the business card. The NMLS ID need to be on the company website. Okay. Either that NMLS ID refer to the company itself. The company also needs an NMLS ID. And if your photo, your profile on that website, then yes, your NMLS ID need to be on there too. Okay. Residential mortgage loan application, the 1003 application, your name, your NMLS ID need to be on there, right? And they're gonna go back and they can track you because this is your unique identifier, right? It doesn't include on the information of the booklet, okay? Like the counseling booklet, like thing to know booklet, right? So NMLS ID does not belong under number D, the CFPB special information booklet. Okay, the refinance, right? The refinance is not applicable to reduction in APR because you're gonna take a new rate, you have a new fee, you have a new APR, then you have a new term, right? You have a new schedule, right? You have a new payment, you have a new amortization, right? So it's just not only APR. APR can be higher. If you do a cash out, right, it's going to be higher. So reduction in APR is not correct. Right? It can be correct if you just refinance, then yeah, your APR may be low because your interest rate that you take may be lower, right? But what happens if you take money out, refinance cash out? Then your APR may be, your rate may be higher, and can be, the APR can be higher too, right? A change in payment schedule is a change in payment schedule because, like, for your new loan, you start all over again, right? You maybe pay already 12 months, and you refinance, now you start over at month number 1. Yes, right? It's change in payment schedule, but not only change in payment schedule, right? It's change in many things. The renewal of a single payment obligation with no change in original term, meaning one payment into the principal and everything else, stay the same. Okay, but this refinance is not that. Refinance is that you take a money from one lender, you pay off the other lender, you get a new, forget about whatever term, schedule, and things happened to the first lender. Now you get the new term with the second lender. So it's satisfaction, meaning what? The first half of this, the satisfaction of an existing obligation. Obligation is that the note, the promissory note that you agreed to pay for the previous lender, right? And now you satisfy, meaning you pay it back. So the satisfaction here, meaning that you complete and you pay back that loan that you take out. So now the second part is say, and replacement by a new obligation. Now you take on the new obligation. Now you take on a new loan, and it's going to replace the old loan. And now your mortgage, your home, going to contain the new obligation or the new loan with new schedule, new rate, new APR, blah, 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 right? So carefully read the question. Number 7, which of the following document does a mortgage loan originator use to determine the estimated value of a property based on an analytical comparison of a similar property sales? All right, what does it mean? Okay, which of the following document? So meaning A, B, C, D down here are document names. Okay, the mortgage loan originator used to determine the estimated value. So meaning the LO use one of these documents, right, to see what is the estimate value of the property. Okay, so meaning the LO trusts this document, okay, to use it as an estimated value to calculate the DTI, to calculate the payment and stuff like that. Okay, and the value is actually based on an analytical comparison. So meaning that it's compare something of similar property sale. So when it's compare similar property sale, meaning that it's do the comp of the area or home that close to this home that got sold, right? So which of the following document does a mortgage loan originator use? Okay, do they use an appraisal? Do they use an area survey? Do they use a market survey? Do they use a cost benefit analysis? Okay, so we need to make sense out of this. An appraisal. An appraisal is a report, right? That an appraiser did and give it back to the LO and the borrower. And that may give some suggestion about the price. And then there are three methods of doing appraisal that the appraiser may use, right? Cost, replacement cost, rental income cost, and also comparison of the property sold in the area. So it seems like, this is probably the one, right? An area survey. Survey what? Survey land? Survey the economy of a local area? Survey what? It doesn't say. A market survey. What kind of market are you talking about? Real estate market? Or you mean stock market? Right? Nothing clear, right? Cost benefit analysis. Cost benefit of what? Selling a car, right? Sell merchandise. Okay, and this is analysis for that. Cost benefit of what? Not clear, right? So by now you probably already know what the answer is. Okay, number 8, according to ECOA, right? Age discrimination by a mortgage lender is acceptable. Is it true? Okay, so this question is, should we say true or false? But they don't form it in that way. They form it by give you like a several answers so that you can pick from. But they say ECOA is age discrimination by a mortgage lender is acceptable. According to ECOA, age discrimination is okay by the lender. Okay, when there's some discrimination, there's nothing okay, and there are 7 characteristics of discrimination, right? You remember those, right? Age, right? Family status, origin of national or national of origin. Okay, and there's like you have to remember all those 7. I don't remember. You study for the test. I don't need to. Okay, so those 7 characteristics, but age is one of them. Okay, let's take a look. A, not under any circumstance. Okay, age discrimination cannot be under any circumstance that can happen. Or B, only if application is too young to enter into legally binding contract. That's interesting. Too young to enter into legally binding contract. So meaning that you can discriminate them. You may not let them have the loan. That may be true, right? Because you cannot, you cannot be, you got to be a borrower if you're 15 years of age or 10 years of age. There is a limit. And what limit is that? 18 years of age, right? So now A and B are fighting. I'm thinking A, not in any circumstances that you can discriminate a person because of age. But that you cannot take on a loan if you're not at least 18 years of age or qualify for the mortgage, right? Maybe you do make millions of dollars by 18 years of age, then yes, you qualify for the mortgage, right? But at the minimum, you need to be 18 years of age. You need to be grown up, right? So A or B may be a correct answer. C, only if life expectancy data indicate an applicant will not be alive at the end of the loan term. Okay, loan term is 30 years, right? So I will not loan to this person at 90 years of age. Okay, because he may die in a year or two, right? So it's okay for me to do so. But it's ECOA, is the law allowing that. Okay, regardless, hey, who knows? This person may live until 150 years of age. Who knows, right? Okay. D, only if applicant is too young or too old to understand the ramification of defaulting in a legal debt. Maybe this person is only 7 years old or 75 years old, right? Too old to remember anything. Then the lender can discriminate, or the lender will not let them, borrow the money. Okay, so which one is this? A, B, C, or D? Okay, we'll find out. Okay, number 9. When a client's property is being appraised, a loan underwriter, which is the person who works for the lender, may take all of the following action. When a client's property is being appraised, a loan underwriter may take all of the following actions, except, except. I love except, right? So you have to carefully, when you read the question, there's an except here, meaning that 3 answers going to be incorrect, right? Or correct, and 1 answer is incorrect, which is the answer we want to pick, right? It's an except. Underwriter can do all these 3 things except this thing, or not doing this thing. Okay, first one. When so the question is that the property is being appraised, okay? The underwriter can request a second review of the appraisal. Okay. Can the underwriter request doing that? I don't know. Maybe, perhaps, if the underwriter believes that this appraisal is not correct, have a mistake, or not do it well, the underwriter have the power to request something. Okay, the condition need to be met by by the guideline. Okay, let's say if this is a VA loan. Okay, and somehow there is an appraiser going out and appraise the loan, and that appraiser is not a VA, approved appraiser. Then now the underwriter say, hey, you hire somebody that not within the VA approved list. Maybe you need to send out the VA approved appraiser. Okay, so request a second review of appraisal. Maybe. Okay, we'll see. Ask the appraiser to consider additional property information. Hey, Mr. Appraiser, you're looking at these 3, but I think you should also looking at these 4 or 5 or 6 homes to re-evaluate your appraised value. C, ask the appraiser to correct an incidental error on the appraisal. Hey, Mr. Appraiser, I see that you probably make some mistake here. Correct it and then give me back the report. Or D, inform the appraiser that the appraised value is contingent on the client retention of the principal dwelling. What does that mean? Hey, Mr. Appraiser, this appraised value need to be contingent on the client retention of the principal dwelling. Not this is for investment property. Meaning that you only give me the appraised value if and only if this is for owner occupied. Okay, because I believe if it is an investment dwelling, investment home, the value might be different, right? So this question is a little bit tricky, or this answer number D is a little bit tricky. Okay, so there's a couple things. Now we try to answer the answer here. Okay, so this line D is suggesting that if you appraise as a owner occupied, it may come out with one value. If you appraise as investment, it may come out a different value. Can that be happen? Usually not, right? Usually appraised value for a property, regardless of the intention, either for owner occupied or for investment, property or rental, right? But the method that the appraiser used could be the cost to build a home, the comparison of the home nearby, or the income coming out from renting this property, right? Use one of those 3 methods, come back and give me one value. Okay, so what's the answer? Right, so the answer are, okay, so the document that the LO is using is the appraisal, right, to help with estimate the value of the home. That's number 7. Number 8, okay, discrimination only if application is too young to enter into a legal binding contract. So like I said, the person that take on the loan need to be 18 years of age or or older. It's not cannot be on under any circumstances, because a 5 years old cannot take on a loan. But guess what? A 5 years old can own the property, can inherit the property. A dad can buy the child a property, right, with a guardian. So let's say Richie Rich or the Home Alone, right? That kid making like millions of dollars, he should be able to buy a home under his name, right? You can own a home, but you cannot stand on a loan if you're not a grown up, if you're not at least 18 years of age. Okay, so the lender can discriminate or not allow. In this case, it's not actually discriminate, but it's not allow if anybody younger than 17 years of 18 years of age. Okay. Number 9. Okay. Loan underwriter may take all of the following action except. Okay. The underwriter can request for a second review of the appraisal. Hey, you need to redo it, or give me another appraiser and redo this home appraisal. Ask for the appraiser to consider additional property information. Yes, the underwriter can do that. Ask the appraiser to correct a problem, an issue on the appraisal. Yes, can do that. So those 3 are correct. So the accept is the D, right? Inform the appraiser the value. You cannot inform anything. The appraiser come out a report based on his or her evaluation, and you just using it as an underwriter. You just use it. You don't ask to change. Okay. So we got that. Last one. According to the CHILA, which of the following fees is excluded from the calculation of the APR? Okay, we got an APR. Which of these is the one that we not use in that calculation? First, wire transfer fee, prepay interest, hazard insurance, mortgage insurance premium, MIP. MIP usually for VA and FHA, right? Okay, I know. Wire transfer fee. Sometimes, the loan officer can pay off that for, not pay off, okay, not pay off, but, cover, or sometimes they waive, right, depending on the broker. Okay, so wire transfer fee, prepay interest. Prepay interest is it's a fee that's calculated in the, within the, all the costs. Okay, hazard insurance. Okay, is it calculated in the cost? Mortgage insurance premium. Okay, hazard insurance could be fire, could be like flood and all that. Okay, so it's asked which of the following fees is included in the APR calculation. Okay, APR is the rate plus all the associated loan costs. Loan costs, and you add all that up and combine that into the APR, into the rate to become an APR. So loan cost is a wire transfer fee, is a loan cost. Is a prepay interest a loan cost? Is a hazard insurance is a loan cost, or even MIP is a loan cost? And the answer is hazard insurance. Okay. Hazard insurance is excluded. Okay, because it's on the even with the property tax, it's optional. It's excluded. It's not in the APR because you cannot including the because it's a one-time charge. Okay, when you first purchase it, it's a one-time charge, right? And you repay that every year, right? And that amount can be go up and down too. But APR is a fixed. Okay, so wire transfer is in the fee, prepay is in the fee, and also MIP or mortgage insurance premium is in the fee. Okay, so you see that depending on the question, you first have to understand the question. Secondly, you have to understand every answer and pick the right one. Also meaning that this stuff right here is actually on the closing disclosure, mainly on the closing disclosure. Loan estimate maybe not completely yet, but closing disclosure. So now you have to go back to the closing disclosure and make sure you understand where these fees are at. And are they included in the APR, right? Are they in the finance part? Or are they in the prepaid part? Okay. So that's how you study. Thank you. Anybody have any questions? Is it helpful? I'm a little bit overrun here. Good. You like that kind of review, or you think it's too much? I'm not telling you to do the answer, right? I want to explain the question and guide you to use the strategy on how to analyze the question, how to analyze the answers, and maybe, pick and choose, divide and conquer, pick, throw away the one that you don't think is correct, and then focus on the one that is probably correct. And then from that point, pick and choose the one that's correct. So any question? Good? No, what are ta? Good, Joe. Sure, good. Okay.
I have a question. Oh,
Okay, go ahead.
Can I ask, before you say like how much for total for the test will be, like question on the test will be?
87 correct to pass. There
80.
is 120 question in total. 5 questions. You answer all 120, so that you don't miss the one that they randomly pick 5 and not use that on the final result. So you have to answer 120 questions, okay? And then they're gonna get rid of 5 automatically. Okay, and then they're gonna pick 115 to grade. And then you have to correct 87 or more to pass. Okay, if you don't correct, get any 87 or more, then you're gonna fail the test and have to retake it.
Okay.
Okay, John, any question?
No, I don't have any so far.
Okay, how do you like the question?
Yeah, pretty much. Yeah.
Together?
Yeah.
Okay.
You can review it. Yeah. Make it like more interesting. I think so. Yeah. Yeah.
Awesome. Okay, so I'll see you tomorrow. Okay, for the next 2 class for California, the FPI. Okay, have a good night.
Thank you.